Hi guys, welcome to the second part of our Forex Time Cycle lesson. In the first part, I explained the time cycle of the currency market in detail. If you haven't seen that video, you need to watch it before this one for better understanding. In this video, we will be applying the time cycle on the chart to show what it looks like in practice. On the screen right now is the Euro USD chart. I will mark the cycles using the most recent quarterly contract, the 3 monthly contracts in it, and the weekly contracts. So without any further ado, let's get it started. The first thing we are going to do is to mark out our quarterly contract and the monthly contract, as well as the weekly contract in the last quarterly contract. And the last quarterly contract is the September contract. In order to mark this easily, I usually go to the 4-hour time frame. We are going to mark the quarterly contract first to know the exact date the quarterly contract ended and the December contract was opened. We have to go to the calendar to see the third Wednesday of September. Right now we are on September 2024, so the third Wednesday of the month was 18th. That means the quarterly contract was ended on the 16th of the month. That is the Monday, and that Monday, Tuesday is when the December contract was opened. So the price action for the December contract will start on Wednesday, which happened to be the third Wednesday of the month. So what we are marking now is the Monday, Tuesday of this week. So that's 16th of September and open of 18th of September. Right now we have the Monday, Tuesday of the December contract open, which means the first red line marks the end of the September quarterly contract. So we go back to the open of the September quarterly contract, which happens to be in June. So to mark that, we also have to check the calendar to know the exact date. Now we are in June, so we now look for the third Wednesday in the month of June, that is 19th. That means the 17th to 18th is the Monday, Tuesday contract used to open the quarterly contract. So we are going to mark the open of 19th and the open of 17th. So let's go on the chart and mark that. Now we have our quarterly contract marked out. As you can see, this is the old quarterly contract. Now the next contract we have to mark is the monthly contract. As you already know, the June contract marks both the September quarterly contract and the July monthly contract open. So the next month we are going to mark is July. So let's go back to the calendar to check the exact date. July 2024. Now we have this as the first Wednesday, second Wednesday, third Wednesday. The third Wednesday of that month is the 17th. The Monday, Tuesday of that week is the contract opening Monday, Tuesday contract. That is the 15th and 16th. So we are going to mark the open of 15 and the open of 17. I'll have to change the color of that to blue to signify that that is monthly contract and not quarterly contract. So let's go ahead and do that. So the next one is the August monthly contract. Let's go back to the calendar to check the exact date. This is August. As you can see, the first Wednesday of the month is the 7th. Then we have 14th and 21st. That means the Monday, Tuesday that will be used to open that monthly contract is the 19th to 20th of August. So we are going to mark the open of the 19th and the open of the 21st. Now we have the quarterly contract marked and the monthly contracts within the quarterly contract also marked. Now the next thing to do is to mark the monthly contracts before the quarterly contract open, because we are going to need the range of that monthly contract for our analysis. So let's go ahead and do that. So that will be the month of May. Let's go back to our calendar to check the Wednesday for May. So the first Wednesday is the 1st and the third Wednesday is the 15th. That means the Monday, Tuesday for the monthly contract open is the 13th and 14th of May. So 13th and 14th of May is what we are going to mark. Now we have our quarterly contract and the monthly contract within it, and also the last monthly contract before the quarterly contract open. The next thing we are going to mark right now is the midpoint, which happens to be the reevaluation phase of every contract. So to do that, I use the Fibonacci time zone tool. We spread the Fibonacci time zone tool from the open of the quarterly contract to the open of the next quarterly contract. As you can see, the settings of the Fibonacci time zone tool is not what we expect it to be. So let me put all this off. So the three we need is just 0, 0.5, which is the midpoint, and 1. So that will help us to identify the midpoint of the contract. As you can see, this is the 0.5 point, which happen to be the midpoint of the quarterly contract. So I'm going to mark that also with another vertical line. I make the line dashed so that we can know the point we are as the midpoint of the quarterly contract. So that is done. Now the next thing is to mark the midpoint of the monthly. So for the first month of the quarterly contract, the midpoint is right here. We continue marking for the remaining monthly contracts. We have the midpoint for July contract right here. We have the midpoint for the August monthly contract right here. And we have the midpoint for the September contract right here. And here we have the midpoint of the quarterly contract. Now we have marked our monthly and quarterly contracts. If you like, you can go ahead and mark the weekly contract, which will be Wednesday to Wednesday. But for this video, I don't think that is necessary because we are looking at a bigger time frame. So what the monthly and the quarterly contract is doing is what we shape the weekly contract. Now that we've marked all our monthly and quarterly contracts, the next thing to do right now is to mark the fundamental direction for each of the monthly contracts. To determine the fundamental direction, you need to check out the fundamentals data that was released for the previous month. The fundamentals are usually released just before the monthly contract opened. So you have the last one, which is usually released, is the inflation rate and CPI, and that comes out on the calendar week just before the monthly contract opened. For these 3 months, the fundamental direction was bullish. Because the fundamental direction is bullish doesn't mean the whole price action for the monthly contract is going to be bullish. That's why we have the fundamental target, which is usually the high of the previous monthly contract or the low, depending on the direction. This is also bullish, and the final month is also bullish. So the direction for the quarterly contract is usually the direction of the monthly contract in which that quarterly contract is opened. So the direction for this September contract is the fundamental direction of the July monthly contract. So now that we know our fundamental direction, the next thing we have to mark right now is to mark all the institutional heavy orders that come into the market in this previous monthly contract and also in all the monthly contracts within the quarterly contract. So to do that, I need to go to my Euro USD chart where I mark my orders and look at all the heavy orders within that period and mark it. So I'm going to run through that and come back after that is completed. So these are all the big orders that came into the market within these periods. That's the quarterly and the monthly periods within it, and also the monthly contracts before the quarterly contract was opened. These are real institutional heavy orders that came into the market. The orders are usually reported in the COT report at the end of the weekly contract. The problem with that is that it comes late and also it doesn't tell you the day the order was opened or the price point the order was opened. So that makes it difficult to use just the COT report. So with all the heavy orders marked, now let's go ahead with our analysis to know how this helps us to shape the market. The day we mark these orders, it means an active order was opened on that day for sale, and also a pending order placed right at this price point, just in case price wants to go higher so that they can capitalize on the sell move and increase their total position. So right here we have a pending sell and an active heavy sell on the same day. So how we use that is that when the order comes into the market, we know we should be expecting price to fall. But after the contract is done or during the reevaluation phase, any pending heavy order that is yet to be activated before the reevaluation phase or before a new contract is opened, that type of pending order becomes liquidity, which draws price to itself for the next contract or the next evaluation phase. When the pending orders come into the market, they are telling us the institutions are already selling the market heavily and they are putting pending orders just to increase their accumulation in case price decide to come a little bit higher than where they opened their sell. So let's go ahead and start the breakdown. So as you can see, this is the open of the quarterly contract. At that point, we already know the fundamental direction is bullish. So we mark our bullish target, which is the high of the previous quarter and the high of the previous monthly contract. The high of the previous quarterly contract is the quarterly target, and the high of the previous monthly contract is the monthly target. So let's go ahead and mark that. So this is the high of the previous monthly contract. As you can see, the monthly contract started from here and ended here. The high of that contract is the target for the monthly contract. And for the quarterly target, we have the high of the quarter. We didn't mark the previous quarter, so we need to mark that so we know the exact high that is the quarterly target. This quarter right here is June. The previous one will be in March. So let's go back to March and see the date that quarterly contract was opened. So now we are in March. The third Wednesday of March is 20th. That means that quarterly contract was opened on the 18th. So let's mark the 18th of March. That is the previous quarterly contract open. That means this high right here is the quarterly target. That's the fundamental target for the quarterly contract. So let's go ahead and mark that high. At the quarterly contract open, we can see the institution started buying heavily. They put in a heavy order on the first day, which is Monday, and on the second day they put in another heavy buy order just before the evaluation phase starts. And like I already explained in the previous video, we know that during the evaluation phase, the market will head in the wrong direction just to pick or run liquidity and activate more orders just before the market will start heading in the original direction. And as you can see, that's exactly what happened right here. Immediately the contract opening period ended and the price action began. That is when the evaluation phase starts, and you can see price started going down just to pick this order, run this liquidity right here, and from there they started heading up to the monthly target. As you can see, for the first phase, which is the evaluation phase, you see price came down and started the buy move right here, but the buy didn't really take off until we got to the midpoint of that monthly contract. And at the midpoint, I told you the institution usually do re-evaluation. The re-evaluation at this point is to check if they have reached the fundamental target and if they have any pending order that needs to be picked or mitigated after the fundamental target is reached. But at this midpoint, which is the re-evaluation phase, you can see that the fundamental target is yet to be reached. That means there is no need for them to come and pick the pending orders right here, so the institution can just drop and reaccumulate a little bit for bullish price action in the same direction as the fundamental bias. That's exactly what they did. They retraced a little bit in the wrong direction, and then price started moving straight in the direction of the target. And as you can see, the target was reached right here. But at the point the target was reached was exactly the point of opening of the next monthly contract. Before I move on, I forgot to extend the pending orders that were unpicked in the previous contracts. Those are target points that we can also use, and they are very important because those are the levels the price will reach for. Those are the real liquidity in the market, and as you can see, those levels were picked. That is that for the first monthly contract. At the second monthly contract right here, we are yet to reach the quarterly target. That's the quarterly fundamental target, and as you can see, for the second monthly contract, the bias is still bullish. So the target for this new monthly contract will be the high of the previous monthly contract, which is very close, and that high is just this point right here. And as you can see, immediately the market opened, they head straight for that monthly target and also the monthly target of the previous contract. Immediately those two targets were reached, the price started retracing from there. Don't forget, we are yet to hit the quarterly target, which means we are still bullish. Immediately we entered the evaluation phase. Price head straight for that target because the target is very close. The reason why there was no need for accumulation phase or price heading in the wrong direction in this case is because the target is extremely close, so there is no need to reaccumulate since the distance to be covered is short and the profits that can be made is little. So there is no need for the institutions to start reaccumulating or accumulating new positions just for the target that is already almost reached. At the point of hitting all the fundamental target is where they do their re-evaluation, and in this case what we do is we look at the previous period, which is the last monthly contracts re-evaluation phase, and check if there are pending orders there that were not picked. Those heavy pending orders will be our target for our re-evaluation. So this is one of such pending orders right here, and we have a second one right at this low. So since the pending orders that were yet to be picked are below current price at the point of hitting target, that means the price will be repriced straight down to come and pick those pending orders for the rest of that trading period, which is the evaluation period just before the midpoint of the monthly contract. That's exactly what happened. At this point on this day, the institutions opened a big sell order just to confirm that yes, they are truly going down to pick this pending order from the previous period. Anyone that wants to trade this will enter at this high after the quarterly target was reached, or enter at this reaccumulation phase here after the heavy sell order has confirmed the sell move, and price went straight down to this pending order right here as target. And as you can see, at the point price was hitting that level, you already see the institutions bringing in heavy buy orders right here. Immediately we start seeing such heavy buy orders, we know definitely the institutions don't intend to go and pick this one that is far away. That already confirmed to us that we are going to be getting a bullish move in the re-evaluation phase. Right here is the midpoint of the monthly contract and also the midpoint of the quarterly contract. Before I continue, I would like to let you know that quarterly contracts lead to very strong or very long lasting move right at the evaluation and also at the re-evaluation. So the beginning of the quarterly contract is where we get the longest move in the market, that's the longest swing, and also at the midpoint of the quarterly contract is usually the beginning of the longest swing. Then the next long swing is the monthly contract. At the beginning of the monthly contract, that's the evaluation phase of the monthly contract, we get a long swing. So at the beginning of this monthly contract and quarterly contract, we got the reevaluation and then a long move started. As you can see, that's a very strong bullish move, which is a quarterly move. At the beginning of this monthly contract, we got this move to the downside, which was quite a trend. And right at the midpoint of that monthly contract, we expect a longer swing because that midpoint is also the reevaluation phase for the quarterly contract. Immediately we cross the midpoint, we expect price to be bullish. That's because we've seen that the institutions were bringing in heavy buy orders right here, and also we have our previous trading period pending order right here. If you check the previous trading period right here, there was no heavy buy order left. The heavy buy order that is here is from the previous monthly contract, and we are looking at the evaluation phase of this second month. So that means we should be looking for bullish price action, and right at the reevaluation phase, price headed in the wrong direction just to run all these lows right here, and from there they started pushing price to the upside to pick this target. After the target was picked, we got heavy sell orders coming in, which showed us they want to retrace, and you can see price started retracing, but at this low they started buying heavily again, which is telling us we should continue the trend to the upside. And also because we already know that the trend that is started at a quarterly evaluation or re-evaluation point is usually very long, so we don't expect just this move to be the whole bullish move. Since it's a quarterly re-evaluation phase, we expect it to last longer than this. So that's why this continuation came into the market. So that is the second monthly contract completed. I hope you guys are following it. Now to the third monthly contract, the direction fundamentally is bullish. That means the target for that monthly contract is the high of the previous monthly contract. So let's mark that. So this is the target, and as you can see, that target was reached while the contract was just being opened. And the reason for that is because price was already very close to that target at the contract open. So immediately they open their contract, they just go straight for the target. Right at this point is when the monthly contract opening was done, so we expect price action to start. And since we've already taken the fundamental target, that means we need to reevaluate the institutional order book. We look at the previous trading period for the heavy pending orders that are yet to be activated. Those are what withdraw price to themselves. So in this period, we add this one which has been activated right here. We now have this which is yet to be activated. So this heavy order right here is the only pending order that was left in the previous trading period. So that is what we draw price in this first phase of the new monthly contract. And to confirm that price is coming to that area, we need to see the institutions opening heavy sell, and that's exactly what happened right here. We see the institution putting in heavy sell order right here. And as you already know that at the evaluation phase, we want to see price head in the wrong direction first before heading in the intended direction, and that's exactly what they did. Price went all the way up, they put in their heavy sell order right here, then continued up to activate that pending sell order, and immediately they activated that, the sell move began. But in this trading period, the institutions were unable to fulfill the target, which was drawing price, before they got to the midpoint of that monthly contract. And as you already know, at the midpoint of the monthly contract, we expect the institutions to reevaluate their book. That is, they need to check for the pending orders in the previous trading period that is yet to be picked, and we expect price to draw to that price point. At the midpoint of this monthly contract, we go back to check the price action here and the pending orders, and as you can see, there is no pending orders left unpicked in this trading period. All the pending orders have been activated. And also, it is very important to note that the institutions started putting in every buy order just as they approach the midpoint of the monthly contract, which is the reevaluation phase. And what that is telling us is that they expect bullish price action to come into the market. Right here at the reevaluation, since there is no pending orders left unpicked in this trading period, that means we should expect price to continue bearish to try to reach this target, which was the target for the previous trading period. But because we are in the reevaluation phase, we will expect the price to head in the wrong direction first, grab some liquidities, and start heading towards this expected target. And as we already know, the institutions started putting in heavy buy, which means yes, they are even planning to trade that fake move to the upside because they expect it to be long. That's exactly what happened. The fake move to the upside started, price headed up, grab all this liquidity right here, and at this point the institutions put in heavy sell order again in the market to confirm that yes, they are ready to continue in the original direction. Price started coming down, but also on that day they put in buy order, which is telling us they don't expect the price to go too much to the downside before reversal. That's why they are already putting in buy order also, while they have the sell to confirm our direction for us. Price started heading down as expected, activated the buy order that they put right here, and on this day they put in another heavy buy order, which is telling us that most likely we should not expect price to get to this target. And also the reason why that is because this target is for the previous period. This reevaluation right here has no target to go for, so that's why we expect it to go for the previous target that was not reached. And as we can clearly see what the institutions are putting in terms of heavy orders, they are buying heavily, which means they want to push price to the upside. And at this point is where the inflation data was released, and we know that fundamentals are usually the beginning of impulsive move in the market. And since we already see that the institutions were putting in heavy buy, we know the market will most likely start heading in the buy direction. And that's exactly what happened here just before the close of the quarterly contract. And that is how the quarterly contract was ended. Let's just go ahead and do the analysis for this period right here. As you can see, the target for the new quarterly contract is this high right here, which is the high of the previous quarter. Just the same thing we did in the previous quarterly contract. Let's make it red. So the target for the quarterly contract is here, and that same high happens to be the fundamental target for the monthly contract also. So what do we expect? We expect price to go in the wrong direction first. It just came down to pick some of the liquidity, and because we are close to the target, we don't expect it to be too much. So immediately they picked this liquidity, they started heading up again straight to pick that target. And after the target was picked, the next thing is for us to reevaluate our book and check if there are pending orders that are yet to be picked. And as you can see from the previous trading period, we had this pending order right here, which happened to be on the same level. These two happen to be on the same level, yet unpicked. So that means we should expect price to head for that pending order after the fundamental target was reached. And you can see the confirmation right here. The institutions opened their heavy sell order on this day, and price started heading straight to the downside. So that is how to use the market time cycle for forex market. This applies to the currency market. If you are trading gold, Nasdaq, you need to go and study the futures contracts of those assets so that you can know how the contracts are delivered. For instance, gold does not have a quarterly contract. In the case of gold, it is usually 2 months. So instead of 3 months, you have 2 months in the case of gold. So if you are using this quarterly contract just as it is on currency on gold, that means you don't know what you are doing, because gold does not have a quarterly contract, and that is exactly why you need to understand the asset you are trading on the futures level so you don't get surprised in the market. For an uninformed trader that just sees a very long swing happening here, they don't know why there is a long swing here and why this swing right here is short. But as an informed trader, you know the reason why this swing here is long is because it is the beginning of a quarterly reevaluation. This is a quarterly reevaluation move, and this is a quarterly evaluation move. That's why it is long. But in this case, it is a monthly swing to the midpoint, which is the reevaluation of the quarter. That is why this swing is short and this swing is longer. And if you keep going forward, right at this point where we are currently with this heavy move to the downside is also the midpoint of this current December quarterly contract that we are in, and that is why we have a heavy swing to the downside right here instead of the short ones that we've been having. This is the first heavy swing, which is the evaluation of the quarterly. That's the beginning, and the midpoint is this second swing that we are trading right now. So that is the practical side for the Forex time cycle. I believe you guys understand it. If you have any question, you can ask in the comment section of this video. I'll be so glad to answer your questions. Please don't forget to like the video, and if you are here to subscribe to this channel, go ahead and subscribe right now so that you don't miss out when we drop our content. I'll see you guys on the next one. Have a good day and enjoy your trading.